Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, the AI boom's phantom demand for electricity fuels a $500 billion utility rally, breaking the sector's traditional link to interest rates. We'll explore how Wall Street's re-rating of utilities as AI growth stocks creates bubble risks and threatens a sector once considered a safe haven. Second, as the S&P 500 nears highs, new tariffs force small businesses into high-cost debt, acting as a canary in the coal mine for the US economy. Today, we'll take a closer look at this growing divergence between Wall Street and Main Street and its implications for the Fed's stagflationary policy dilemma. Third, gold surges past $4,300 an ounce as a broken stock-bond correlation kills the 60-40 portfolio, forcing a massive institutional shift to alternatives. In this episode, we'll break down this fundamental failure of traditional portfolio hedging and what it signals for investors and global reserve diversification. The AI gold rush has a dirty secret. Tech giants are proposing server farms that consume as much electricity as entire cities, but there's a catch. They're shopping the exact same projects around to multiple utility companies at once, creating a massive wave of so-called phantom demand across the country. This practice is creating a huge problem. Utility companies use these requests to plan their capital expenditures, known as capital expenditure, for years into the future. So when they see multiple massive requests, they might start building new power plants based on inflated numbers. The core issue is the risk of overinvestment. If this projected AI demand doesn't actually materialize, utilities could be left with billions of dollars in stranded assets, power plants, with no one to sell electricity to. And guess who ultimately pays for that? Consumers through higher electricity bills. While utilities struggle to tell what's real, the stock market is betting big. The utility sector has exploded, gaining nearly $500 billion in value in a rally not seen in 2 decades. A while back, we talked about policymakers and the IMF warning that eye enthusiasm looks stretched. Now, what's fascinating is how this optimism has spilled over into a sector once considered the safest corner of the market. This rally signals a fundamental shift in how Wall Street views these companies. Traditionally, utilities are seen as defensive bond proxy stocks. Their value usually goes down when interest rates go up. But recently, that historical link has been broken. Investors are no longer buying utilities for their stable dividends. They're buying them as a growth play on AI. Continuing our last discussion about the IMF, flagging excessively optimistic. Eye expectations, this utilities as growth trade is exactly the kind of re-rating that can unwind fast. A correction could be triggered not just by a change in Fed policy, but by a downward revision of AI forecasts. But some insiders are sounding the alarm. The CEO of nuclear operator Constellation Energy issued a stark warning, telling investors, quote, "I think the load is being overstated. We need to pump the brakes here." Even OpenAI's CEO, Sam Altman, cautioned that the market is facing an AI bubble and getting overexcited. That caution rhymes with what we highlighted a few days ago. When central banks see this kind of exuberance, they get wary about financial stability risk. But that's not the whole picture. To give you a sense of the scale, one forecast estimates new data center demand could require 60 gigawatts of power. To put that in perspective, that's roughly the entire peak electricity demand of Italy. A separate plan from OpenAI and Nvidia alone would require as much electricity as New York City on a hot summer day. This all begs the question, how can they possibly power this? The infrastructure isn't there. So let's talk about the grid's bottleneck. It's not just about building power plants, it's about connecting them. In the US, there's a massive waiting list called the Generator Interconnection Queue. Think of it as a line of power projects waiting to plug into the national system. One major grid operator, MISO, which covers the central US, has a queue of 309 gigawatts of projects, but its actual peak load is only 127 gigawatts. The line is more than double the size of the entire existing system. Natural gas turbines are largely sold out for the rest of the decade. And the problem extends beyond just turbines. The scramble for power is creating a focused inflationary shock on critical industrial components. The lead times for essential gear, like large power transformers, have ballooned from around 50 weeks in 2021 to an average of 120 weeks today. This is a classic supply and demand squeeze that drives up the producer price index, or PPI. This kind of industrial inflation is exactly the pressure that keeps central banks cautious, and it can bleed into the broader consumer price index, or CPI, complicating the Fed's fight against inflation. This has led to a radical proposal from NVIDIA's CEO Jensen Huang, who says the solution is to simply build power at the data centers themselves, completely off the grid. What he's talking about is known as behind-the-meter power generation. This isn't just a theoretical idea. It's already happening. For instance, Microsoft has signed a deal to buy electricity directly from a nuclear fusion startup called Helion Energy, which, interestingly, is also backed by OpenAI's Sam Altman. This move is a leading indicator of a potential new trend, a privately funded energy transition that leapfrogs the public grid. Tech giants could accelerate the adoption of advanced energy like small modular reactors, or SMRs, to power their own operations. The race for AI dominance has become a brutal battle for energy, forcing tech titans to become their own utility companies as they collide with the physical limits of the nation's electric grid. Looking ahead, the critical questions will be whether these phantom demand forecasts turn into real projects and how quickly tech companies move to build their own private power grids. As we've cautioned in earlier episodes, if policymakers stay wary and markets derate AI, that shift will echo through utilities, capital expenditure plans, and ultimately consumer power prices. This will determine not only the future of AI, but the shape of our entire energy infrastructure. We just talked about the disconnect between AI hype and the physical limits of our power grid. Speaking of major disconnects, another one is widening between Wall Street's record highs and the painful reality for America's small businesses. For one footwear company owner, new global tariffs have meant taking on a loan with a staggering 32% interest rate just to stay afloat. And, this isn't an isolated case. It's actually a symptom of a much wider credit squeeze. Behind this, the Federal Reserve's own surveys of senior loan officers show that banks are actively tightening their lending standards, specifically for small businesses. As these tariff costs bite into balance sheets, demand for high-cost credit is surging. This is a critical leading indicator because it often precedes a wave of loan delinquencies and even bankruptcies. And he's not alone. The financial strain is piling up across the board. Another company, Village Lighting, saw its expected tariff costs explode from under $50,000 one year to at least $1 million the next. For Picnic Time, a 43-year-old family business, tariffs are projected to jump from $950,000 to over $2.25 million. So why the sudden squeeze? For years, we've heard about companies trying to de-risk their supply chains by moving out of China. But the truth is, this has become a game of whack-a-mole. Many firms that shifted production to countries like Vietnam or India are now being hit with a new unpredictable wave of tariffs on those very countries. This creates investment paralysis and stifles capital spending. This brings us to the core conflict. We're seeing Wall Street celebrate near record highs, while at the same time, Main Street is facing a completely different reality. This growing divergence is fundamentally unsustainable. And it's so critical because since small businesses represent over 40% of the nation's GDP, their struggles are a direct signal of an impending downturn in consumer demand and employment that will eventually hit the big companies too. They're being forced to freeze hiring, slash research and development, and pass costs to consumers. One tool startup had to cut its R&D budget by 20%, cancelling plans to hire new engineers. And this isn't just a future threat, it's already showing up in the data. The latest ADP National Employment Report showed that small businesses have actually been shedding jobs for several months in a row, one of the first concrete signs of cracks appearing in the broader labour market. The personal cost is immense. The CEO of Village Lighting, who is now using a line of credit against his own home to pay the duties, put it bluntly, it's to the point now where it could kill us, it could take us down, and I could lose everything. Another owner added, being a small business owner isn't worth it when your country turns on you. These businesses employ nearly half of the American workforce. According to a professor at the University of Pennsylvania's Wharton School, this is a major warning sign. He calls these small businesses the canary in the coal mine, predicting they will get hit first with a delayed but significant impact to follow for the wider economy. Now, get this. The situation presents a fascinating duality for economic policymakers. On one side, these tariffs are creating sticky inflation for goods as higher costs are passed on to consumers. On the other, these same tariffs are hurting businesses and squeezing consumer incomes, which dampens demand. This creates a stagflationary risk, that toxic mix of a stagnant economy and high inflation, forcing the Federal Reserve into a tough choice between fighting inflation or supporting a weakening economy. So the indicators to keep a close eye on are small business employment data, like the monthly ADP report, and sentiment surveys like the NFIB Optimism Index. If they continue to weaken, it's a strong signal that the struggles of these canaries are about to be felt throughout the entire economic coal mine. That stagflationary risk we just mentioned is forcing investors to rethink everything. For decades, the go-to strategy has been the 60-40 portfolio, but now it's facing its biggest challenge in decades. A new playbook is emerging on Wall Street, 60-20-20, with fixed income losing half its allocation to alternative assets. We previously analysed how prominent voices challenge the old model. The latest development is that this idea is effectively being institutionalised at scale. The reason is a massive pivot into gold. The precious metal just shattered records, surging past $4,300 an ounce and is up over 60% since the beginning of the year. The numbers behind this shift are stunning. Gold ETFs posted their largest monthly inflows ever, pulling in nearly $11 billion in September. According to Sprott, the total assets moved into gold funds this year have now surpassed a jaw-dropping $38 billion. However, if you zoom out, you'll see another layer of strategy at play. The real story driving this structural shift is what central banks around the world are doing behind the scenes. For several years now, central banks, particularly the People's Bank of China, have been buying gold at a historic pace. This sustained buying is a significant signal of a strategic, long-term move to diversify reserves away from the US dollar. For our listeners in China, this is especially noteworthy as the PBOC's addition of 225 metric tons of gold in the past year alone is a leading indicator of this global trend. The implication here is a fundamental change in how global finance works, which could lead to higher US borrowing costs and more currency volatility down the road. One ETF director confirmed the trend, stating that prominent economists are suggesting a move away from the old 60-40 model. But gold isn't the only asset crashing the party. Bitcoin also roared to a new record high of $126,000. Demand is explosive, with the iShares Bitcoin Trust taking in close to $1 billion in a single day earlier this month. Now, with all this money rushing into these alternative ETFs, there's a new risk. Professionals are watching a liquidity mismatch. Here's where it gets interesting. These funds offer investors the ability to buy and sell every day, but the underlying assets, physical, gold, or crypto, might not be so easy to sell quickly in a panic without causing the price to drop sharply. This can amplify a market sell-off, so it's a key point to watch. If that was just the appetizer, the main course is just being served. Believe it or not, the alternatives bucket is a battleground. As one head of research for Verify noted, investors need to understand the difference. Gold is a risk-off safety play, while cryptocurrency is a risk-on bet. To understand why this distinction is critical, let's look at an indicator the pros watch called the VIX, or the market's fear gauge. Research shows that when the VIX spikes, meaning fear is high, gold's price tends to rise. It acts like insurance. Bitcoin, on the other hand, has historically shown the opposite relationship. Its price tends to fall, behaving much more like a high-growth tech stock. Interestingly enough, this shows that even though people group them together, they serve completely different purposes in a portfolio. Recent market action proves the point. While gold continued to move up, Bitcoin saw a sharp sell-off, dropping over 8% in a week right after hitting its record high. Even silver has joined the fray, hitting its own record of $53.59 per ounce. With silver, what's driving this is its soaring industrial demand, especially for green technologies like solar panels and electric vehicles. This means silver's price is becoming a unique, real-time gauge of how fast the global energy transition is happening. What really brought this to a head was a fundamental breakdown in how markets are supposed to work. For decades, the logic was simple. When stocks fall, investors rush to the safety of government bonds, so bonds go up. But that relationship is broken. The correlation between the S&P 510-year US Treasury bonds has been positive for an unprecedented 18-month period, meaning they are now moving up and down together. In short, when your stock portfolio is down, your bond portfolio is no longer providing that cushion forcing everyone to look for new solutions.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.